afternoon and welcome to Unlock the Stock. As you know, this platform is designed for retail investors to gain access to corporate management and to get to know them and their companies better. This episode is sponsored by Easy Equities, the platform that helps you grow and protect your wealth. So invest in local and international shares, property, unit trusts, crypto, bonds, and actively managed ETFs. Plus get access to Easy Protect life insurance and Easy Credit lending to back your financial journey. We are pleased today to welcome Astoria back to Unlock the Stock for the third time, and we are joined by Piet Viljoen and Jan van Niekerk, who will take you through a presentation shortly. Unlock the Stock is only possible with our technology partner, RECM Global. Please visit their website, recmglobal.com, to learn more about their various online AGM and investor presentation solutions. Our host today will be Tobin, who will lead the Q&A sessions. But before we begin, a few housekeeping notes, please. Jan and Piet will take you through the presentation, as I said, followed by a Q&A. You can post your questions by typing them into the Q&A box at the bottom of your screen. This event is being recorded and will be available on our YouTube channel soon, together with about 40 other videos, so please do have a look at that. You will see an email address when we begin the Q&A, so please take note of that if you'd like to be added to Astoria's distribution list. Jan and Piet, nothing further from me, so I'm going to ask you to share your screen and take us through the presentation. Thanks.
Thanks, Deborah. Hi, Mark, and good afternoon, ladies and gentlemen. Myself and my colleague Jan van Niekerk are here to talk to you about Astoria. So if we can start off by looking at the history and what we are trying to achieve. First of all, Astoria is a Mauritian-domiciled investment holding company, is listed on both the Stock Exchange of Mauritius and the JSE. And RECM Global, that is basically myself and Jan, have been managing it since December 2020. So it's just about 4 years I've been managing the assets of Astoria. Our aim with Astoria is to grow the net asset value on a per share basis at a high real rate over time, measured in US dollars. So we want to give investors a high real rate of return in US dollars over time. And we aim to do so by utilizing the flexible mandate. We can basically invest in anything, anywhere in the world. However, our network, Jan and my network, sits in South Africa, and we think that is the value we bring to the table here, and that is where the bulk of our investments will take place. However, we do invest in South African businesses that operate globally as well. So, and that's why we can say that we want to generate a high real return measured in US dollars. So on the right-hand side of the slide shows the results we've achieved in the 4 years that we've been managing the assets of Astoria. And in dollar terms, we've compounded by 11% per annum, which is significantly above US inflation. And in rand terms, we've compounded at 17% per annum, which is significantly above South African inflation rates, which is basically almost the same as US inflation. So far in the past 4 years, we've managed to achieve our goal, but we aim to be around for a long time, and we want to continue to achieve this going forward. And I think the bulk of today's presentation will be about how we are going to take this forward and what our strategy is to do so. Basically, we see ourselves as investing with founders and operators of good businesses. So we team up and partner with teams of entrepreneurs who are building great businesses. Our existing portfolio of companies all have defensible moats, either in the form of licenses, brands, and scale, or a combination of those three things. And therefore, they can all generate high returns on capital, and they can also, importantly, reinvest their profits at high returns. And we encourage them to do so wherever possible. And all of us are aligned. Myself and Jan are heavily invested in Astoria, and the management teams are heavily invested in their own underlying businesses. So everybody is aligned to achieve the goal of high real returns in US dollar terms. How do we think we're going to continue creating this sort of value? First of all, we think relationships are the important thing here. RECM has a reputation as being a value investor, and that's true when we deal with listed companies. In the listed market, the JSE, companies listed in the JSE, those companies are subject to wild swings of emotion. The market gets very optimistic about the prospects of a business from time to time and drives the price up to very high levels. And at other times, Mr. Market gets very pessimistic about the prospects of that very same business and drives the price to very low levels. And that's where value investors get involved and try and extract that. In Astoria, we are not value investors. We see ourselves as value creators, and we try and create value through the relationships we have with the companies that we are invested in. We try and implement a win-win investment strategy. In other words, we help the company win, and thereby Astoria wins. And helping the company wins means we aim to be supportive partners of the business of it over the long term. We are not in and out of it for a quick gain, quick uplift in profit. We want to be around all the companies we're invested in for the long term, and we want to support these businesses where we can to achieve high returns. That means we're capital partners, not controlling managers. Jan and myself have no idea how to manage a business like Piet. We couldn't get involved. Even if we wanted to, we wouldn't be able to add any value at that level. But in terms of capital allocation and acting as a sounding board, that's where we think we can add value. And that's what we try and do with all our businesses. And on the right-hand side, you can see all our businesses dominated by outdoor investment holdings. You'll see we have the second biggest holding there is cash and receivables. That represents the bulk of that is the proceeds we have to receive from the sale of Isaac Carson's. Jan will talk about that a bit more. And you can see the rest of our investments there as well. Jan is going to deal with each one of those individually going forward. So I'm going to hand over to Jan to start talking about each one of our investments.
Thanks, Piet. I think perhaps just the one thing I'd like to say before we go into the other businesses, as a long-term investor, we think making good capital allocations is the best way we can help the underlying companies, but also being a supportive shareholder. You can choose to conduct a relationship with the people managing the businesses, either in a controlling way or in a supportive way. Our style, our nature, and our history has been to be supportive shareholders to the underlying businesses. So I think it is important. That gives us a reputation in the market, and that means that we get to speak to the types of entrepreneurs that we can work with as well. So we think that's a self-reinforcing point there. To talk about the various, before I get to OIH, as Piet mentioned, we have been a shareholder in Isaac Carson's roughly since 2019. We invested originally in Isaac as a 49% shareholder. We became a partner to the family that had started the business at the time. It was about 40 years old, and we helped them over the subsequent 6 years to institute proper management systems and to grow sales. And we got to the point where it was just appropriate, and Isaac was worth more to everybody, to the new sellers, and that's why we got to the point to the new buyers, the new owners, and we got to extract and realize our profits, and we're expecting to receive those cash proceeds later in this month. So let's call it May into June. So we're very close to finalizing that transaction, so that cash will come into the business. When we talk to the remaining parts of the business, OIH started as a small company, and it has been very successful in growing in many parts of the industry. OIH, through its brand Safari and Outdoor, Inyati and Formalito were the importers, and then recently the bigger brand, the adventure brands, have been very focused at a specific niche, which is the hunting and outdoor group in South Africa. Safari and the management team is very strong to understand who their customer and their target market is, and not straying from that, and making sure that they service that market in the appropriate way. And over the years, the brand has grown incredibly strong. So in the last financial year, what we have seen is that the retail side of the business, which is the stores, they have seen an uptick in turnover, mostly through increased trading densities. later in the year, in about November, we opened our second country store, which is a smaller format. It's smaller in the context of Safari, but it's still a big store. It's 800 squares plus in Bloemfontein. And that is after we've proven that these country stores, a slightly smaller formats, is working. The unit economics is fine. So the team have opened another store there, which leaves us with 5 mega stores, 4 in Gauteng, 1 in Stellenbosch, and then another 2, which is Nelspruit and in Bloemfontein now. During the year, as we wrote in our shareholders' letter, OIH had an interest, a 1/3 interest in a Norwegian manufacturer called Altx. In the past year, there was an offer for the shares on Altx from an outside party. We had the option to remain as one of 3 investors or to cash out. It was our choice, or the management of OIH choice, to rather, take the money and bring it back to South Africa. As it turns out, the actual returns on that investment was quite low. We basically got back the money that was invested in Altx at the time, but we thought it was better suited to redeploy that capital back in South Africa than leaving it as a minority in a business that's owned by 3 parties in Norway. The remaining part of the business, South African business, we had profitability. EBIT was up 5% for the year. And we keep on valuing the business at the same price. OIH pays a dividend on a regular basis. So, Astoria received 8 share of its dividend over the last while. Going forward, the profitability and the growth of the business lies in expanding its footprint in South Africa and being able to grow turnover, densities in all of its stores. And we do see that Adventure Brands, which is sort of a sporting goods wholesaler, doesn't do any of the hard brands. That's growing quite fast, and that will bring additional value to the overall group there. And we're very comfortable owners of that business.
Yeah, I must say, I'm not a hunter, but I like going to the safari shops because the Adventure Brands are really attractive outdoor kit to buy. So I encourage you all to go and visit a safari outdoor shop, and I will bet that you'll buy something there. Adventure Brands are a really good brand and building a lot of momentum.
It's a feel-good business, and the value of a strong brand is it brings more customers, it gives us more feet, and it gives us an opportunity to price the products right. So we're very proud of what the team's done there. The second largest after the cash, the second largest unit or allocation was at the end of December. Was our investment in Diamond Assets. Now, you'll recall originally we were invested only in Transex, which was the South African portion of all Transex, the land-based assets, which basically owns 1/3 of a mine in Angola. That's a very profitable mine. It has been profitable for a very long time and has been providing cash to the business. What happened, diamond prices since basically March 2022, diamond prices have been falling consistently, came from high levels. So in the first year, which was the 23 financial year, both of these businesses were still profitable. Then in the 2024 year, the land-based business was still very profitable, but the marine business profitability came under pressure. And then with prices falling even further, the marine business has got to the point where the cash flow of that business is now in quite a tight spot. During the year, we also had the one big vessel, which is a big mining vessel, was in dry dock for a period, so they couldn't produce. So in that year, there was sort of a lack of production and prices were under pressure, which means, for a mining or a primarily producing business, the cash flow came under pressure. Started mining, on time late in the year, but ultimately there's pressure on that. So we had to take that into account in valuing these 2 businesses. So at the end of December, when we put the fair value on the businesses, you'll see in our annual report that the land-based business value increased, and that was based on the actual sales, the value of the diamonds, the prices, and the cash in the balance sheet, whereas we reduced the value of the marine business to reflect the fact that pressure. Subsequent to that, in our March valuations, we wrote down the marine business to 0 at this stage, so it's valued at 0 in our book. And we said, well, we think what could happen is that, to help this business through this current period of weak diamond prices, there is a risk that the land-based diamond business will have to provide financing there. We made an estimate of what we think that could be. So we have written down the value of Transx, the land-based operations, also in that period. So in the March valuation, we've written down the value of those 2 diamond mines. At the moment, the team is working, as you would expect, as hard as they can. Cost cutting is obviously the first thing they can do, and which they have done. The second one is to find spots where we can mine with the marine vessels, where we can mine larger diamonds and get better pricing from that, because as it turns out, the marine business is basically a floating diamond mine. So we have our own concessions where we can sell or mine diamonds, but we also can move those ships to other parts where we can find larger and diamonds with better pricing, and that's the 2 main agendas. And of course, and the third one is the management team is in constant conversations with the banks, because the marine business does have debt in the balance sheet, and but the bank has been involved in all of that from day one.
I think it's probably worth pointing out that there was a rights issue a year ago, which we didn't participate in, which diluted our stakes from 25% to 14%. So at the moment, we're sitting at 14%. And we'll see what the road is going forward, but at the moment, it's still super tough.
And I mean, that's the best information we can give you at the moment about that business. And we understand that mostly, I mean, to see us with the 87 or 90% or 100% as we've done now is uncomfortable, but you are our partners in the business, and the best thing we can do is to keep you honest and transparent view on the underlying assets of the business. It doesn't mean that we've given up and that we're not trying and that the management team has stopped. In fact, all the energy is going in there at the moment. So that's the current update. The third largest asset in the business, in the Astoria portfolio at the moment, is Piet Corporation. For those of you that are familiar with Piet, it was started and built out of South Africa. Piet manufactures or have it manufactured, but they design and distribute practical, safe, and desirable protective wear for people that take part in dangerous sports. And that brand has been growing consistently over the last number of years. They had a big bonus from sales just shortly after COVID lockdowns. That bonus has disappeared, so sales have come off for a persistent period of about 18 months. The sales have started growing again from the third quarter of last year. They had published their first quarter results yesterday, and we've seen a continuation and an acceleration of sales growth in that, which is testament to the fact that the management team there, between Chris Liet and Sean McDonald, that they have been building not only the brand, but also the sales and the distribution capacity. And they have managed the balance sheet of the business conservatively in a period where most of the outdoor brands have been owned by private equity firms and had lots of debt in the balance sheet. This company sat with basically a quarter of its market cap in cash, and half of its market cap sits in, today's market cap is cash and inventory. So a very comfortable and strong balance sheet and very well managed. We have huge respect for the way in which the management team have come through the last period, and we are comfortable they keep on growing this business. Because Liet sells into the US, we are obviously all concerned about tariffs and the impact of tariffs. I think it's public knowledge. We're not sharing stuff that nobody else knows. At year end, the 12-month sales of Liet, about a third of that was sales into the United States. Yesterday on the conference call, it was disclosed that for the quarter, about 20% of sales went into the US. So 80% of Liet sales happens outside of the US. Of that, about 10% in South Africa. So obviously there's concerns about the tariffs on sales into the US. As far as we understand at the moment, many of the tariffs are in pause. Liet manufactures a lot in China and in Vietnam, so those are countries that are impacted. But as it stands at the moment, products being shipped out of those areas into the States are subject to the minimum of 10% tariffs, and then the negotiations are ongoing. How does the management team deal with this? Well, as you would expect an entrepreneur to do, Sean got on a plane and flew over to China and to Vietnam and went to see all the manufacturers, people that they've had relationships with for the last 15 and 17 years, worked out a plan on how everybody can work together, and then flew over to the US to go and motivate the team on the ground. So again, practically doing what we expect of good entrepreneurs to do in managing their business. I don't know if you've got anything to add to that. After Piet, the current fourth largest position in our portfolio is we own participating preference shares in Gold Rush Holdings. So Gold Rush Holdings, the company is listed on the JSE. This company owns 59.4% of Gold Rush Group, which is an alternative gaming business that's been grown by Mergen Naidu, was founded by Rech and Mrs. Naidu. This business has grown to be the preeminent alternative gaming operator. The business started off only with limited payout machines, then they built an electronic bingo terminal business, the retail betting business, and most recently we've built an online gaming business. So keep on adding verticals and the skills and the experience of running a successful online business. Gold Rush report its results separately, so those will be out in the third week of June about. But what we can tell and what is public information is that on the land-based operations, so there's electronic bingo terminals, limited payout machines, and the sports betting, they continue to experience sluggish performance. So whereas the online gaming is growing very quickly, and that's, if you follow the gaming stats throughout the country, that mimics what's happening in the industry. Our view, and we discuss this with the management team regularly, is that obviously online is busy finding its market share in the country. It's very difficult for us to try and predict what that will be, but Gold Rush is part of that, and they're running a very profitable online gaming business. So we will have to find our spot, and when that the balance between land-based gaming and the online business settle, then we can make further decisions about capital allocation. But for the time being, the business is done with its capex. Most of what's happening now is maintenance capex. We're not putting new growth capex into, at least not into the land-based part of the business, but we are sweating that, and the team is sweating that to generate the return on capital that it deserves. The one bit we at the back end of last year, what one would have expected to be some positive news was the uptick after the government of national unity. There were some interest rate cuts, and there was withdrawals from the two-part pension system, and none of that actually helped or benefited Gold Rush at that stage.
It's probably very good. People withdraw their pension. I think we should just add one thing. There is a caution out on Gold Rush, came out last week, for a potential transaction, which we can't say anything about at this time because of the cautionary, but just be aware of that. And then the last investment we want to talk about is Flexi Mobility. So this was previously called Vehicle Care Group. The last time we spoke, we said that the business has we've passed proof of concept, and we are now in the stage of professionalization, which means that we have recruited additional and strong management skills into the business, which has come on and helped to strengthen credit policies, sales policies, systems, procedures. This is a business that lends itself to scale, and it has to build scale. And in South Africa and any other part of the world, in order to build scale, you need to have strong systems and strong foundations. And the last about 18 months has been all about building that foundations and the scale. What has happened is that the model of the business or the verticals stay the same. Flexi Capital provides working capital to used car dealers, and Flexi Drive manages a fleet of passenger vehicles, and that's second-hand and new vehicles. So not only second-hand vehicles that get leased to mostly to families or individuals, to retail market. In the last year, the Flexi Capital loan book we've kept the size of the book roughly at the same size, and what we've done is we've reshaped the distribution or the balance between the various clients there. We instituted a bit stricter lending criteria just because of the macro environment. Whereas on the fleet side, we've been able to expand, and that fleet's now up to 1,342 vehicles at the end of December, up from 912 a year ago. So that keeps on growing. Another big milestone we discussed at the end of the year is that this business has been able to source third-party funding from institutional funders
for the growth of that fleet business. So, first of all, we had grown that book from our internal networks and friends and family and so on, but that's now a fully fledged third-party funding. And to pass those due diligences was a big comfort for us, but it means that the strengthening of the systems that's been put in place is the right stuff that's been done. So, in our view, this next year is the last phase of investment. So obviously, as we improve systems, structures, and technology, there's a last phase of investment in salaries and in IT development. At the moment, the business is funding all of that itself, but it comes at the expense of actual profitability or cash flow profitability. This is the last bit of investment before that profitability gets to the point where either we pay dividends or we decide to reinvest that into the business. So, because of the history how we have set up the business, the original funding was done through shareholders' loans. The equity value at the moment we value at zero, and the shareholders' loans is valued at a discount to its face value. That is our best estimate of the current value of the underlying business. We should be converting those loans into equity in the next year and then run it in a conventional manner. Perhaps the last point I just want to make before we open for questions and answers, Astoria is Mauritian-domiciled, but most of its assets are in South Africa. When we got involved in managing the portfolio of Astoria, there were questions about, are we looking to immigrate or are we looking to invest the money outside of South Africa? As Piet mentioned earlier today, our network is basically in South Africa. And most of the skill and the value we can add in terms of relationships, is here. So as you can see from the portfolio, a lot of our portfolio is also dominated by South African companies, but we do get the question around currency. So since we started, taking responsibility through RECM Global, the rand's depreciated by 22.3%, which is about 5.6% a year. Obviously, we are looking to generate returns which is much better than that, and therefore we don't bank on a currency to generate returns. Here, the important message is that underlying assets has to generate the returns. The currency will swing. I mean, last year it was 3.2%, which is below the average, and in some future years it will be more, and other years the currency will strengthen. But for us, fundamentally, we view and look for the great assets we can buy, the underlying assets, because they can generate good returns on capital, and through our relationships with the management teams, we can have some influence on how that capital is allocated. So I think that concludes the prepared comments on some of the underlying assets market view. We can open for some questions. We'd be happy to take those.
Thanks, Jan, Piet, for sharing. And obviously now we're going into the Q&A session. So just a reminder before Mark takes over, just to type your questions into the Q&A box at the bottom of your screen, if you've not done so already. And so over to Mark.
Thanks, Deborah. And yeah, just welcome to Jan and Piet. Thanks for coming back on Unlock the Stock and joining us. And I think we've got about 60 people on the call. So very welcome to everybody here today. I'll just make an apology for the finance ghost. He's not able to join us today, so you're stuck with me for the next half an hour or so. Jan, Piet, I just wanted to maybe touch on the disposals that are happening. There's the Isaac Carson's one, that's in train, getting very close to, completion. There's the Altx disposal. In terms of the cash that's going to be flowing back in, what are your thoughts on how that's going to be, allocated going forward? Let's say for Altx, that's within the Outdoor Investment Holdings group. So, is that going to fund more store rollouts there? Is that kind of the plan for that capital? And Isaac Carson's, I often wonder, is there a lot of deals coming across your desk that, are looking attractive for, when you come full cycle on an investment like Isaac Carson's, where you've bought in, now you've realized, now the cash is back, and now you've got something to do with that capital?
I'll make a couple of introductory comments, and I think Jan can talk to some more specifics. But I think if one takes a step back and you look at Astoria right now, its net asset value is around 11 Rand, 12 Rand a share. and that we think that net asset value is conservatively stated, and it reflects a group of businesses that are generating high returns on their capital. And right now the share price is trading at half of that. So we have an opportunity to either buy Astoria shares, in other words, more of what we own, or we can make new investments with the proceeds of the sales we've made. The hurdle rate for new investments is massive. If you take what we have generating a high return and being able to buy it at half price, in other words, double that high return effectively, versus a new investment, which we don't know the people, we still need to get to know them, we still need to get the business. The hurdle rate to take that money and invest in a new business is very, very high. I'm not saying we're not going to do it. I'm just saying the hurdle rate to make that new investment is exceedingly high. So, Jan, maybe you want to talk about some more specifics.
Yeah, I can. To add to that, the only business in our portfolio that potentially could deploy additional capital would be Flexi-Mobility. ORH doesn't require any more capital to grow. VCG, Leah doesn't require capital to grow. Gold Rush doesn't require capital to grow. So it's definitely no need to reinvest any of that capital into existing businesses. We might want to, if we want to expedite the growth of Flexi-Mobility, which we don't really need to, but that could be the one option. In terms of new opportunities, we do see new opportunities all the time, but the hurdle rate, as Piet has highlighted, is quite high. It's high returns at a discount. So we have always been proponents, and we've criticized other management teams for not allocating capital rationally, and we pride ourselves at being rational capital allocators. So it makes sense for us to look at that, definitely.
And as for the Altx sale within Safari and Outdoor, that is for Safari Outdoors management to decide what they are going to do with it. Okay. Of course, Jan is on the board, so he takes part in those discussions, but that's their decision to decide what they're going to do.
Okay. We've got a question in here.
Mark, sorry to interrupt, but perhaps the one thing is that this ORH in South Africa has been able to sustain its own growth rate without the capital that was allocated to Altx. So one would assume that capital is not needed in South Africa to keep on growing.
Okay. We've got a question in here from the audience, and I think it's relevant. It was on my list of questions, to have a discussion around the diamond businesses. And the question is, is the fall in diamond prices secular, cyclical, or is it structural? We've seen a lot of talk about synthetic diamonds, their impact on this current fall in real diamond prices. So yeah, maybe just give us your thoughts on, where you see the market dynamics playing out between synthetic, real, and how that impacts on prices, in the medium term, let's say.
So I think the short answer is we don't know whether it's structural or cyclical. It's hard to say. In any cyclical business, it looks darkest just before dawn, and it looks brightest just before the sun goes down. At the moment, it looks pretty dark for the diamond business. Synthetic diamonds have taken significant market share, especially amongst the smaller stones. De Beers' weak position in the industry exacerbates this factor because they are not there to sort of protect the industry anymore. Anglo's is cutting them loose, and they're not financially that strong. So there's a whole, and then you have the Russian influence where, under sanctions, they are selling diamonds in the market at below market prices. One is told, I don't know if it's true or not. So there's a whole bunch of events happening at the same time, which are contributing towards the low diamond prices. Will it carry on forever? I don't know. I do think that there is a market for high quality gems, specifically diamonds, and that market isn't going to go away. It probably will be smaller than it used to be. But in the meantime, where the rubber is hitting the road is in our diamond business, specifically our marine diamond business. That business needs cash. It's not making enough money to pay its costs at the moment. And that's a decision we have to take at some point.
On the marine business, is it possible, I guess a bit like land-based operations, is it possible to put the ship into kind of care and maintenance, just kind of leave it there in dry dock and then just remobilize the crew, when the diamond prices make sense?
Yeah, on paper it's possible, but the practical implications of that make it difficult. If you mothball your ship, you have to get rid of your staff. If you decide, if the diamond market recovers in a year's time, you have to re-employ. Where are you going to get the staff? Where they're going to come from? I think you lose a lot of skills. You probably lose your best skills in that process. So it's very hard to recover from that. Mothballing a ship also costs a lot of money. It's not a free thing that you do to put a ship somewhere in a dock and mothball it. But management is weighing up all these different options, and the ball is in their court to make the right decision for the business. And as shareholders, we will then support their decision once that is made.
I'm going to change tack quickly here if we can, and just talk about Piet for a little while. Obviously, as you mentioned in your comments, they had a bit of a surge in sales in 2022 / early 23, and it's come back a lot, and it's still trending negative. But from what you're hearing and seeing, do you think they can get back to those sales levels, margin levels? The investment that they're putting into the business now in terms of probably distribution, new product development, all of the things you would try and do as an entrepreneur to kind of recover lost ground. Do you think it's feasible, or was that a one-off blip where I think the sales were like 70 million or something like that? Is that a one-off market blip, and actually it's it's going to be slow, steady, kind of consistent growth, over a number of years is kind of more the outlook?
I just want to point out that sales are actually trending up the past 3 quarters. They're trending up. They're not trending down. And if you look at yesterday's results announcement, you'll see that is the case. So that's a very important point to make here. Sales are actually trending up after bottoming about a year ago. But Jan, you're much more in tune with the business. You can answer that better.
Yeah, so I think it's right, Mark. The second quarter and the third quarter and the first quarter of this year, sales have been improving, and that growth in sales is accelerating. So the current 12-month run rate of sales is just under $50 million. So you're right. I mean, they peaked at just under 80, and then at the bottom it was about 40. So sales halved over that period, and it's already picked up by another 20% since then. But the short answer to your question is absolutely. I mean, Piet has all the infrastructure it needs. The business model is, and that's why we like this business so much, is it can grow substantially without requiring any capital. The value in the business sits in the relationship with the production and the manufacturers in Asia, their distribution scale that they've built around the world, not only in South Africa and the US, but also in Europe and in Asia. The product design team, I mean, since 2022, in the last 3 years, the design team is so much stronger. The sales team is so much stronger. The way management has managed the business, the balance sheet between inventory and stock, we're very comfortable. There's not old stock sitting there. They've been working through the stuff that had to be sold out. So all the stuff that you have to be suspicious about in a business going through a tough time, the guys have done it in a right way. So we think, the infrastructure can handle $100 to $120 million of sales very easily. Can we predict when we'll get there? No, we can't. What has happened is that sales have been improving at an increasing rate, which is very pleasing to see. Our senses, and I mean, the management team can't give forecasts, and they don't, so we have to work on our own assumptions. But we think Piet's run rate, 12-month run rate this year will be somewhere around $55 million. Which is quite a bit up from previous numbers, and it's done at the right margin. So I mean, the gross margins are 44% plus. The expense ratio is under control. So we're very comfortable that it's going to go there, Mark. Back to 80 million very quickly. You don't want to manage a business with a quick rebound in sales. I mean, you'd rather have the guys grow it at a consistent basis by strengthening their distribution network.
We've got a question here on Do you guys have a, return on equity, return on invested capital target for Astoria as the group? Or is it more the focus on, we want to, as you said at the intro, you're really focused on high growth in NAV per share in dollar terms? Is that like the key metric for you rather than looking at ROE, ROIC at a group level? I know one feeds into the other, you could say.
Yeah, I think they feed into each other. So we definitely look at our underlying businesses, at their returns on equity that they generate, and when we would like them, and they do generate high returns on equity, and that translates into a high growth in NAV per share at Astoria. And that's our job, is to grow that NAV per share, either by making new investments, by adding to our existing investments, or by buying back shares. Those are the three levers we can pull to grow the NAV per share based on the underlying growth in the business we own.
Yeah, I think it's important, like the per share part of that is very important. We are shareholders of a number of units of shares. So for us, the value per share is much more important. We don't value on income statement metrics. We value the underlying value.
Okay. Another question on Transhex in terms of how does it, and they didn't specify now if this is the marine business or the land-based business, but production costs, where the question is, where do they sit on the curve relative to other producers? I know this is a thing mining analysts like to look at all the time. Who's the low cost producer in the industry, who's medium, who's on the high side, because it all factors into profitability when you're a price taker rather than a price maker.
Yeah, I think one should just make the point that in the diamond mining industry, one diamond isn't the same as another diamond. The larger the diamond is, and the more pure it is, and the more carat it has, and the less flaws it has, the more valuable it is. So one diamond miner at a certain cost level can make a lot of money if it is producing high quality, large gemstones, whereas another diamond miner at the same cost level might be losing money because his diamonds are smaller and of lower quality. So it's very hard. I know in platinum and gold and those sort of and coal and those sort of mines, cost of production is a key factor to look at in terms of where you sit in the cost curve and how vulnerable you are. In diamond mining, I don't think you can do that. I think you need to look at the margin. And right now, the margin on marine diamond mining is low to negative, but the margin on land-based operations is quite high. And it's all to do with the quality of the gemstone being mined.
Okay. We've got a question here on the Mauritian listing. So we've just seen, African Rainbow Capital have, had their meeting, I think it was about 3 weeks ago, where they've approved the whole delisting and all of that. But one of the things that they called out as the reason for going down the delisting route was a change in the tax setup between Mauritius and South Africa, and it wasn't as attractive as it maybe once was. Maybe just touch on that from your point of view and how recent tax changes are making the Mauritian listing maybe not as attractive as it once was, but overall, are you still happy to keep the current structure, let's say, between the dual listing with Mauritius and the JSE?
The current structure suits us well. There are distinct differences between the Astoria structure and what the other guys had, and we can discuss that offline if anybody wants to talk about the details. For us, it's been beneficial, and it's definitely been beneficial for our shareholders to have the Mauritian domicile and the way of managing in that way, Mark, and we have no intention of changing that.
It remains very beneficial.
Okay. Yeah, let's not get into a full-blown tax and structuring conversation here, or we'll all be asleep before lunchtime.
Offline. As Jan mentioned, we can take that offline. Happy to talk about it and the differences between ourselves and ARC, but they are significant, and we think they're very favorable for our shareholders.
I will make this overall observation. No jurisdiction, when you actually start operating, your experience is a bit worse than what they have on the sales brochure. the hidden taxes are a bit more than, and it's only once you get there and you start operating and you understand what minimum bank payments, transfers, etc., will be. But that's the case in all jurisdictions. And obviously we keep an eye on all of those. So it's not just Mauritius where that's the case. We review this regularly. It's still super beneficial to us.
Okay, great. Yeah, if we've got further questions, please reach out to the guys and we can get more in depth in what we've got time for here. If we can just go back to the car business, as you say, you're nearly at the end of that process of preparing it for scale. But one of the things we've seen come through, especially Combined Motor Holdings, called it out, and Super Group have called it out, and the impact of the Chinese brands coming into the South African market, most notably kind of post-COVID. I'm just wondering, what impact that change in brand badges has for the flexi car business. Is it an opportunity to partner with these like new entrants? Does it take some existing relationships away? I know like Volvo are closing down a lot of their outlets. Some of these more smaller legacy brands are really cutting their footprint in the South African market. Obviously, your Volkswagens and your Toyotas maybe not to the same extent as market leaders, but definitely some of the smaller ones. So maybe just in terms of scaling up, how working maybe with some of the Chinese brands is going to impact the flexi business.
Mark, we are brand agnostic, which is a lovely position to be. Remember, most of what Flexi Mobility does is we deal with the used car market, not with the new market. So you're right. We see in our business that the Chinese brands are becoming bigger and bigger. If any of you have not driven or tried the Chinese vehicle, I recommend you get to one of the brands and get in those cars and drive them around. The value for money is extraordinary if you compare that to many of the European brands. And that's the knowledge we have because we operate on the ground. Also, the distribution model is a bit different, where the European and the Japanese brands have local partners and the locals run that. The Chinese distributors come into the country themselves, so they don't really outsource the sales of their new vehicles to third parties. And I think that's where the tension with the new car dealers are, especially if you are doing European or Japanese or Korean cars. So that's definitely happening. The issue for us in this business is on both sides, whether it's funding, floor finance, or the long-term rentals, is we need to get our head around what is the ultimate depreciated value of this asset, because we do asset-backed finance. So the obvious thing we would do in the floor finance business is just to take a very conservative view on the resale value of those assets. Our typical loans in that business is about 49 to 60 days. So we know very quickly it's not long-term loans. The money comes back very quickly. And then when it comes to the fleet business, we're experimenting, and we've included a number of the Chinese vehicles in there so we can track the performance, and the depreciation curves are very important on that. I mean, our entire business there is based on knowing exactly what the depreciation curve is for every model and every year and every make. So we're experimenting with some of those. They're still a small part of the overall fleet. So for us to grow the Flexi Mobility or the Flexi Drive fleet from 1,000 cars to 5,000, we can do all of that without having any of the Chinese brands in there. But in that process, there will be enough time for us to learn about those vehicles. And it's nice to know that our partners and the management team in that business are car nuts. I mean, they live in that part of the world, so they drive those cars all the time. They're on the road all the time, so they've got a very good sense. And then in our service providers, when it comes to the insurers and the recovery businesses and so on, there's a lot of industry knowledge that we can tap into to help us to manage the risk in that business.
Do you know what the size of the second-hand car park is? How big it is? No. But I mean, for us to go from 1,000 cars to 5,000 cars doesn't touch size. I mean, it's a tiny fraction of that market. So, I don't think our business, at least in the medium term, will be influenced by what's happening in terms of the mix of cars being sold at the new car level.
I mean, if you want to put scale into that, I think We Buy Cars sells about 13 to 14,000 cars a month. So scale that up, and I mean that's one like a dominant, but that's a big. I think the new car sales in South Africa is 300,000 in a year, and the used car market is about 2.5 times that size. To give you scale of what that market looks like.
We want to go from 1,000 to 5,000.
Okay. Just on I know it's a very small part of the overall thing, but the family care pet business, we've seen a lot of demand for these pet offerings, from ShopRite and a few others. What is your take there in terms of, is this still core to Astoria? Could it be, shipped out to, somebody who's got a bit more scale there? Or do you think it's a bit of a slow burner like OIH where, you're testing the model now, kind of similar to the country store rollout. You're testing the model now, and there is, a scope for this particular offering for, 10, 15 stores if we look out, on a 3 to 5 year basis.
Mark, I think the family pet center business, we're at the final stages of reviewing the business model there. At this stage, the actual unit economics isn't as good as we expected, and I think it's got to do a lot with what you've just said. There's lots of competition in there. Not only the big retailers, but also roll-ups and private equity investors have come into the market. So as it happens, when you have profitable businesses, those profits get competed away, and rightfully so. We're on both sides of the competition there. So where as far as the OIH board's decision, my sense is it's much more profitable to deploy capital. And remember, this business, your capital goes into stock mostly, stock and overheads. And the returns on working capital looks much better in our core business. So that's why every time we look at, do we open another family pet center store, the economics just doesn't justify to open another one compared to one of the alternatives. So my suspicion is we would eventually, either just run these businesses for the profits. One day someone might come past and offer us to buy it, and they'll review that decision. But for now, to me, it doesn't seem like it's a business where we'll put more money into to grow the footprint.
I think if I can just take a step back and have a helicopter view of the business, the Safari Outdoor Investment management team has been very successful in experimenting with different things to grow the business. Some of them have been successful and some of them have been less successful. So if you look back, we've got the 5 mega stores. They're experimenting with country stores. We'll see if that's successful or not. They experimented with their own brands, clothing and outdoor equipment brands. That's been very successful. They experimented with taking a stake in a Norwegian manufacturer. That we've exited that. One would call that marginally successful. A family pet store, probably not great. So there's all sorts of things happening. The wholesalers have been a huge success. So the management team is always trying something, but nothing big enough to sink the ship. But if it's successful, they back it and they make it big. And they've been very good at doing that. And we, as their partners, would encourage them to continue doing that, and knowing that some of them might be less successful than others. Some of the experiments might be less successful than others.
Yeah, that's the nature of the beast, I guess, as an entrepreneur. Maybe kind of one final question we've got on here. It's saying, the Astoria structure seems like quite complicated or whatever, but I think maybe just expand on, this is how an investment holding company operates. I mean, if we take the classic one of like Berkshire Hathaway, I think they've got, like, if I remember correctly from a story I did on them for Financial Mail a while ago, I think they've got 100 plus businesses. So I mean, in terms of complication, try and understand Berkshire with 100 and something plus underlying businesses. So I think maybe just sketch out, why Astoria is set up the way it is, and while on the surface it might look complicated, it's pretty much still your standard holdco structure.
Yeah, no, it's actually a very simple holding company structure. each one of our underlying business has its own management team running the business, operating in their chosen environment. And we don't need to get involved with that. So Jan and I don't need to spend any time deciding on what stock Safari is going to have, or what brands the wholesalers are going to stock, or which area Altx is going to mine in. We don't spend any time on that. The management teams of the business do that, and we own an interest in that business, varying from 8% to 86%, different shareholding. So we think it's a very simple business. We sit in the boards of our investee companies, and we talk to them and we partner with them. So I think it works very, very well. I think if only because it's called investment holding company does one sort of get confused. What are we doing? Are we diamond miners? Are we retailers? Are we car financiers? But if you look at any big listed company, you'll find that they have numerous subsidiaries and other investee companies. Like Tiger Brands, I think has, I don't know what the number is, but like 15 or 18 underlying businesses which they own varying stakes in. That's operating. It's called operating business. It's just an accounting way of looking at things. I don't know, Jan, do you want to add something?
Yeah, I think I'm trying to understand the complication part. Astoria is a holding company that owns stakes basically in 5 underlying companies, or underlying investments. We have a small board. There's no permanent executive management, and we don't add expenses to the cost of the underlying businesses. It might be the fact that it's managed out of Mauritius, but that's for a very specific reason. So we think it's quite simple, and we like to keep it simple, and we like to keep the costs in check.
Okay.
If there are complicated things, we like to get rid of them. So if the person who posed that question, if they can come back to us and tell us where the things are complicated, we will happily get rid of that complication.
Okay, perfect. I see our MC for today is back with us, so that's my cue to stop Q&A and say thank you to Jan and Piet for joining us, and I'll hand you back to Deborah to just wrap up and give us details of our session that's happening next Thursday. And Debs, you're still on mute there.
Apologies for that. Sorry.
There we go.
Thanks, Mark. And thanks to everybody who chose to spend time with us today in this session. And a special thank you, of course, to Jan and Piet for making time again to support our platform, which is obviously for retail investors specifically and to engage with investors. We hope you enjoyed the event today. And if you'd like to watch it again, it will be on our YouTube channel soon. And we encourage you to subscribe to that for all our latest videos. Our next session is on Thursday, the 22nd of May, and will feature another regular to unlock the stock, Calgro M3. And that's all from my side. So thank you and goodbye.
Thanks, everyone.